Hello and welcome to a new episode of Majlis and Markets with your host Hassan Jivraj. Majlis and Markets aims to bring you thought-provoking conversations with influential leaders in Islamic and global markets. In today's episode, we're delving into the Middle East's capital markets. Over the past decade, Middle Eastern bond markets have experienced significant growth and development. With governments and corporates tapping into these markets, bonds have become an essential tool for financing. In parallel, the emergence of private credit has added a new dimension to the region's financial landscape. Furthermore, Islamic finance, and sukuk in particular, continue to thrive as a distinct and influential segment within the MENA's financial ecosystem. Our guest today is Sharif Eid. He is a partner and co-head of fixed income at Amwal Capital Partners, a MENA-focused investment manager. He has been an investor in MENA debt markets for the past 15 years, covering both public and private markets. During our conversation, Sharif and I talked about several topics, including regional markets, private credit, as well as the global sukuk market. Sharif Eid, welcome to Majlis and Markets. Good to have you here.
Thank you. It's my pleasure.
Sharif, before we get into the markets and portfolio management and talking about everything private credit and all these kind of things, I'm really interested in learning about your background and how you got into finance and how you got into portfolio management. I think you're very well known, obviously, in the fixed income world in the Middle East and emerging markets, but I really want to learn about the background and learn about your story before we get into the nitty-gritty. Could you maybe give us your background?
Yeah, sure, with pleasure. So I started off actually from a very technical background. I studied engineering and I actually got a master's in math with a focus on mathematical finance. So this was sort of the heyday of the technical entries into the world of trading and portfolio management in general, right? We're talking about 2006 and 2007. And at the time it was in Toronto in Canada. I started working for TD Securities. That was right around the time, obviously, of the beginning of what was later going to be the GFC. So even though I started trading credit derivatives, I quickly transitioned in the period after that to trading more broadly, whether it was interest rates and more broad credit products. I moved back into the region in 2009, which was a very interesting time to do so, and I joined a firm that was eventually acquired by Franklin Templeton, and that tenure, if you will, was sort of my last 15 years where I looked at the capital markets of the region, the debt capital markets in particular, sort of from their early days of infancy to the significant part of emerging markets that they are today.
Great, great. And this was I think you said in the noughties, right? So we're talking about quite a while back. Is that right? Or
Yes, yeah. So I had my start in 2007.
okay, right in the middle of the beginning of the global financial crisis.
It was yeah. I marked the peak.
Yeah. And then so you worked in a bit in Canada and then you went to the Middle East after, right?
Correct. Yes, I was there from 2007 2009, and that's when I came back. But I
Oh,
guess a bit background, I
wow.
should say. So I
You
was actually born and raised in the UAE, so it was more like I came back than anything else.
nice, nice. And Sharif, what do you do on a typical day? I think people outside of the portfolio management world or fixed income world, what do you do as a day to day as a portfolio manager?
So, really, the simplest way to define is that we're largely, custodians of capital. And what we do, in the simplest ways is to find, the best places and the best opportunities to deploy that within the ways that, that our clients, ask us to. For myself, I work in the fixed income world, and we'll speak more specifically kind of about the range in which that works, because so for many portfolio managers and myself included, that would include a relatively broad definition at times, from money market portfolios, all the way to portfolios that would be illiquid or in private markets. So each has its own sort of idiosyncrasies and requirements, and each client does, but really at its basis, we look for opportunities that make sense. So within the more liquid part, which I think most of the listeners, I guess, would be the ones most interested in, those would include everything from studying companies and countries and understanding their evolution to discover places that we want to invest, as well as reacting to information and changes that happen that can be material on a day-to-day basis. This podcast will probably come up a few days later, but today was the day that Egypt, for instance, obviously had the material devaluation in its currency. So that would be one of the events that a portfolio manager like myself would either have, depending on how you had positioned to it before, would react to or need to react to. And we adjust, client portfolios to make sure they're optimally positioned for, what we see as value in the market and what other opportunities we can take advantage of.
So do you like look at your Bloomberg terminal, or you're looking at Excel spreadsheets and reading articles in the background, or?
That sounds exactly like most days.
Yeah. So
It's
like,
it's certainly a screen of colors on one, and typically a lot of Excel sheets on the other.
yeah, and then I guess like you're talking to your clients a lot, and what before we get into the specifics, but like who, like maybe not at Franklin Templeton, but generally speaking, who are the people that give money to these funds?
Well, I guess the one clarification which I should have said at the time of describing my career. So I had spent my time up until Franklin Templeton until recently, where I joined a firm called MWILE Capital Partners.
Yes,
I'm
that's
still looking at regional fixed income, but so to what my clients today would be. Really, we would look at typically you would find investors from really broad ranges into the space that we do. So we do manage, commingled fund that would include funds from retail investors. That would be places where even I would have my money. But we also do some for, some of the larger institutional clients. So whether it's pensions or banks or insurance companies. And that's where, kind of to the point made earlier, a lot of times an important part of the role that we do is making sure that each of those clients or each of those portfolios is constructed and managed in a way to achieve its ultimate objective, because each of those institutions, and in the case of funds for retail clients, they could at times be seeking different objectives in terms of the returns they target, as well as, the risk and liquidity considerations they would undertake.
great, great. Sharif, when we look at the Middle East, or by extension, fixed income, emerging markets, fixed income, what are your thoughts for the year so far? Like, obviously, we're in March, 6th of March today. So we're not too deep into the year so far. I guess we're coming towards the end of the first quarter. But what are your thoughts on Middle East fixed income markets so far?
Yes, sure. So an important part of answering that question would, I guess, start with, what we think about fixed income markets in general and certainly emerging markets, relatively broadly. And there are, I guess I would say, three sort of main points that, I think should be a good takeaway of where we stand today and, the way we define fixed income investing, in my opinion, in the near and medium term. So the first one, and I think a lot of people are probably aware of it, is that we've had a really material change and a repricing in fixed income. Most people that have been in the market for really any period of time, almost anything that existed, but have generally only experienced a period of declining interest rates. And that goes all the way back to the 80s. And then this doesn't mean interest rate volatility wasn't around, but the consistency generally of interest rates going lower decade after decade was a fairly ingrained characteristic, and that has some important implications. One of which is obviously the kind of strategies that get built over time. So, for instance, you can imagine that strategies that involved leverage have been very successful over this period. So, as we look at a period now where that seems to, at least to a degree, have reset, some of those will need to be at least reconsidered. Charlie Munger, who is obviously a much smarter man than I, so I'll just steal this from him. But he had a thing that he had, which was, I'm going to paraphrase it because I don't remember it exactly, but it was something to the effect of easy money corrupts and really easy money corrupts absolutely. It's a play on the quote about power. And I think that's just a really powerful statement, right? So if you think of these periods that we have been used to of extremely easy money, a lot of ingrained behavior would have come into markets over a long period of time that would probably start being unwound. So we need to kind of think about that in the context of what we think about fixed income. So to the second point, one of the things that I believe seems to have been a result of this repricing is that we're starting to see slightly different relationships between asset classes. And one of the ones that matters a lot to us as fixed income investors is that bonds and equities have typically been inversely correlated. And so what that means is that a portfolio that combined both had the benefit of when one of the two declined, the other one likely rose or did not decline. So in aggregate, holding them both was a beneficial proposition. That correlation has changed quite materially, actually, over the last 2 years. And even though yields in fixed income have gone up quite a bit and they're a lot more attractive, that correlation between the two has now changed. So here again, you kind of get an interesting new dynamic. Is in the previous decades, we got used to a period where interest rates were constantly declining, that capital gains from fixed income started to become a more material contributor to total returns than purely income. And so here, again, one of the interesting dynamics is, an extrapolation of the world that we were in would have been one where investors started buying equities to get yield or carry and are relying on fixed income for capital gains, which is, a completely oxymoronic situation. So that dynamic, in my opinion, also seems to have changed. And with that, again, to the first point, some ingrained behaviors in markets are also likely to change. One of which could be, and I'm not an equity expert, but a big part of, I think what you've seen in equity markets happen, particularly in developed markets over the years, was a big part of share buybacks. Share buybacks always rely, from an economic perspective, on the opportunity cost that money would have. So firms that would keep their money in cash earning interest, or the cost of new debt. In the past, that was easy because it was made more sense to buy shares back. So that's one behavior that you could likely expect to change. And then the third, really, and probably some of the two above, and probably the bigger takeaway here is we've kind of entered a period where now more than any time before, finding good uncorrelated returns has become really important. As you look at portfolios that are more correlated, so I guess we should caveat to some degree the notion that equity and bond correlations have changed. This is something that could obviously change again and go back to being negative. So I don't proclaim to have a clear answer to that direction, but given everything we know today, that at least there seems to have been a change. Wherever we will land, it's unlikely to be where we were in the past. The search for new, interesting places to have uncorrelated returns has become really important. And I think that kind of leads us very well to, I guess, the question that you started me with, which is, where do we stand in the region, right? And I think, obviously we'll talk about, specifics of any country that you'd like, but as a subset of the region as a whole, there's a really interesting dynamic of this part of emerging markets that's offering a fairly unique proposition. We're very high quality, mostly currency riskless, because most of the GCC in particular has pegged currencies, with a really interesting reform story that we're undergoing right now.
Yeah, like for example, if we take Saudi Arabia, for example, I know you and I have discussed about this over the years about Saudi, but what are your thoughts on Saudi since, say, 2016-17 with Vision 2030?
Well, obviously a lot, right? And if we kind of go back, and you're right, this is something that we and as well really most market participants had discussed for a while. We looked at everything that has happened in Saudi since 2016, and I've been observing that story quite closely. And most, frankly, myself included, have had a healthy dose of skepticism along the way, mostly because of really just the grand nature of a lot of what you have, what you had set out ahead of you. Now we'll fast forward to today, and I think one part that everybody would need to acknowledge, regardless of what their views were at then and what they are today, that a really significant amount of progress has been made on practically all functions, right? So think of some of the basic criticisms that you've had of Saudi Arabia over the years of closed society, women didn't drive. Now, not only do they, but female participation has already exceeded the target of the Vision 2030. It doesn't take you very long of stepping into Riyadh to realize that something is different. And then even on the, some of the more qualitative factors, which personally, as a credit person, I follow quite closely, is some of the reforms on the legal framework. There have been a sweeping amount of reforms that have happened, everywhere from, security laws all the way to the new bankruptcy laws that have fundamentally changed a lot of the way that business is being done. So there's certainly a direction of travel that, I think has become undeniably positive, where I think we can start having, where the healthy debate around the subject would be is, now that we've set this direction and we're clearly moving in that way, what are the potential hiccups that can happen along the way? Because things will happen and life is unpredictable. Things like COVID do happen once in a while. And that's really kind of where you would be concerned. And there certainly are some concerns on a credit story.
Yeah, like I'm just thinking back in 2016 and 17 when you and I were speaking about this, and I think Vision 2030 was being unveiled at the time. And, Saudi Arabia, when oil prices at that time, Saudi Arabia was a bit on the ropes and a bit in a fiscal stress. And it seemed like they were just issuing debt in like large amounts, and that they've used a lot of that debt and used a lot of the surplus from oil prices to try and boost the economy with Vision 2030 and all the giga projects that Mohammed bin Salman has been doing. But like you said, right, I think a lot of the changes have taken place and are taking place still. But from your perspective as like a fixed income investor, what are your thoughts on things like value with Saudi Arabia? Like, do you like all these PIF or bank bonds and sukuk they're issuing?
The short answer to that would be yes. I think you're getting an increased diversity of issuance, and certainly the size of the issuance is creating opportunities for investors to buy and allocate and to create some value, right? But I think perhaps one question that we would have as credit investors, which is the fair one here, is that we look we're looking at the story here as now evolving to one that relies more on the non-oil part of the story. And I think there's a clear consensus among fixed income investors that the ultimate destination is a positive one. Even though if you consider today, and this is something that we would have probably been very surprised to see the reaction of a couple of years ago, is that Saudi Arabia's most recent budget forecasts relatively consistent deficits for the next couple of years. We've gone from a period where anything other than surpluses was not tolerated just because of the very high cyclicality that you experience in a very commodity-based economy. But I think people are moving to understand that actually we can digest consistent but contained deficits as long as the money is used productively and the direction of travel is positive. Now, the main concern, which hasn't changed from this understanding, is that this transition is nonetheless dependent on oil. So you are in a state where the transition period could still be rocky. So for example, and obviously extreme cases are not something we always need to think about. But what does a period with exceptionally low oil prices do to Saudi Arabia's direction in that vision? So does oil prices at 40 for 6 months derail the project entirely, or does it not? And how do they manage periods with low oil prices? I think that's where the story has gone from being just an excessively cyclical one not that long ago, which in my opinion is a positive thing. A lot of the very highly rated countries around the world do have deficits and much higher debt to GDP numbers in Saudi Arabia, right? So the deciding factor on the ultimate credit quality, and more importantly for the country itself, where the pricing of its debt is not some of the very basic metrics that you would just look at from Excel sheet. There's a lot more to it. So so everything else that comes with it over time will just be beneficial to the story.
Would you also say, like, for example, Saudi Arabia, which, when compared to, say, other similarly rated names in EM, it still has relatively low debt levels. That's why a lot of, say, international investors still like Saudi Arabia as Saudi Arabia's credit, not
That's
necessarily.
that's exactly right. That's exactly right. And it buys you some of the buffer to the risk that I mentioned earlier, right? So some of the consideration that, we do see, the potential for risk story happen along the way. So I think most people understand that, given that, if we like where we're going and you can afford a few missteps along the way, or unforeseen exogenous situations, that you can still see the ultimate outcome being positive. Now, it doesn't change the fact that the magnitude of the requirement is quite large, right? So here, I think we've spoken very broadly, but if you try to look at some of the specifics, the Vision 2030 has spoken about as much as $3 trillion in investment. But if we don't consider an amount of those magnitude, there's nonetheless about $1 trillion that is committed. That trillion in and of itself is not fundable in the traditional sources, right? So even if the capex on directly on the sovereign balance sheets, as well as all the loan growth from the Saudi banks over the next couple of years is utilized, in addition to everything that we know is PIF is investing, would still require $100 to $200 billion of external capital over the next 10 years to fund this plan. And this we have not scaled to the 3 trillion number, right? So even if you don't have any material problems along the way, the scale is still quite large. So there's still a very big question about how do you attract all of the required capital to come and fund this project. There have been some successes. Obviously equity markets are doing really well. We're seeing a real development there. There's a lot of very exciting IPO stories, so that's certainly a step. The debt markets have also been a successful one so far. Saudi Arabia, well, the GCC really in general went from practically being non-existent in emerging market indices to now being the largest block and certainly one of the more relevant ones. So those are developments that have happened and have happened quite quickly. But we're now moving on to the next steps. So you need all of these to come through, as I say, even in benign situations, without having to deal with anything exogenous that derails us.
Yeah, and just sticking with Saudi just for a second, do you agree with this thesis that a lot of the activity taking place in Saudi is obviously it's government driven? Are you, as an investor, as fixed income investor, not concerned that there is perhaps a bit too much involvement from the PIF and other sovereign entities, having an impact in the private sector, or do you think that's just a natural cause?
I think it's a natural requirement given the importance of the public sector here, as it historically has been. I mean, for anyone that's been around the region for a while, right? We've always discussed, the various forms that all the private sector growth that is required, right? And there are many, rather I don't want to say alarming, but almost alarming statistics that that you would be concerned about when it comes to the private sector. SMEs make up a very small percentage of total loans. You can estimate those anywhere from, across the GCC, anywhere from 5 to 10% of total banking loans, which is extremely small. Their contribution to GDP is 2 to 3 times that. That would be one factor. And then of all of total private non-financial debt, the very large majority of that in the region is by banks. So you have an extreme underdevelopment in many non-sovereign backed or controlled parts of the economy. So it was always going to be natural that any step away from that had to be encouraged by the sovereign. I think that it has become a fairly understood factor. So I think there the concern would be, and I must say, as a person who probably identifies themselves as being somewhat liberal, I'd say I think the ultimate progress is always for having much more free capital and non-government enterprise in a vibrant economy. So I think there the question will be about the handoff rather than the stage. I think in terms of at this stage of development, the requirement for the sovereign to really lead these is quite important. I don't actually think there's another way. I think it would be very interesting to see what will be the next stages. So you have your a lot of the the PIFs of the world and a lot of the other large sovereign institutions that are taking stakes in smaller new companies, funding new deals, and doing a lot of the right things. The question will just be at what point in the next step will they pass this on to the private sector? I think it's a little bit early to judge, but I wouldn't find the current stage we're at to be one to criticize. I think actually it's quite positive.
And what are your thoughts on other credits in the region? Do you have any view on, say, like Bahrain or Oman or the UAE? Do you have any thoughts there?
Yes. So I think as a broad stroke, right, to kind of to cover the region as a whole. So there are some pluses and some minuses, but I think as a whole, the region presents a relatively positive credit story, and our credit markets have behaved as such, for the period. There have been a few issues really, Egypt was the latest, which now is practically resolved, but among the rest of them. Coming out of COVID, you've really seen a lot of positive developments really across the board. It's been relatively difficult to frankly find a very negative credit story. Oman has been an extremely positive story. They've used the increase in oil prices quite positively, deleveraged very significantly, and right now you're looking at Oman having a fiscal break even that's going to be one of the lowest in the GCC. So we might have a couple of years where we see Oman with a better fiscal balance than Saudi Arabia. That's not something a lot of people would have expected to say not that long ago. Bahrain is would be one of the stories that I think has done the least amount of reform and development, but given its scale and its importance and place in the region, those don't materially play into the credit story. Where you've had a little bit more volatility has been outside of this in MENA, so in the likes of Egypt and Tunisia. But for when you look at the MENA markets in general, it's very largely dominated by the GCC, which has just very broadly been a fairly good story.
And do you have any thoughts on, say, the other GCC countries like the UAE or Qatar or Kuwait?
Honestly, from a credit perspective, the answer to that in a good way would be no. These have largely been good stories, and there's certainly different interesting things that have happened along each way. Obviously Kuwait, you'd like to see some better momentum on the political side, but really it's not materially impacting from a credit quality perspective. The UAE has obviously been in a lot of ways a darling both on the on the private and the public side. The public balances have done really well. Dubai is a great story. So Dubai made a lot of headlines for hedge funds moving and the price of real estate, but there actually has been a lot of very positive improvements on the balance sheets of a lot of the Dubai GREs, so Dubai Inc. as it used to be called. And here again, you've seen a slew of very successful IPOs, very interesting companies that have provided a very interesting new depth, and a lot of that has been used to improve the balance sheets and credit quality. So really, a lot of it is again, just very little to criticize from a credit perspective in a positive way.
Yeah, I was just wondering, like with, I think you mentioned when the GCC countries, they were listed on the EMBI or on other indices. This really got like interest from like, asset managers in the US or passive funds and asset managers. Like, why should, international investors or international fixed income investors or passive investors consider the MENA as a good bet to park their money?
Well, look, materially, it's within the emerging market universe. It's one of the few that offers, relative quality. And I think that presents a very, an interesting allocation within the region. So for anyone kind of looking at emerging markets, for the longest time, emerging markets have, would have been brought about, a vision of a lot more volatility and a lot higher yields. But today, emerging markets have developed quite a bit, and the GCC is a very good example of a subset of that. That's really interesting. So that's would be one way from summing it up from a top down. But the other one, and frankly the one that interests me more, is that within this story of reform that we're talking about, you're seeing a real transformation on the private side. And what that's going to mean for the next couple of years is that there's going to be a lot more interesting stories to look at and to invest in. And that's whether you're looking at the equity market or the fixed income market. You're going to see more companies that are going to list on stock markets, more companies that are going to issue bonds and sukuk. And I think you're going to see a very interesting private debt market evolve as well, to the point sort of that we alluded to earlier about just this, there's going to be a fairly large capital requirement. I think actually I should say there already exists a large capital requirement, and it's only going to grow over time. And all of these sources that I mentioned are required pieces to fill in that funding gap.
Yeah. Before we get on to private credit, because I really want to get your thoughts on that, more broadly on the global economy, what are your thoughts on 2024 for I think Nikki Haley just dropped out of the Republican race today, which basically means Donald Trump is going to be the Republican frontrunner, and we're going to have a repeat of the 2020 elections. And in addition to things like geopolitics, and we have the unfortunate situation in Gaza, and we have other geopolitical stuff happening in Yemen. But what are your thoughts on 2024 with regards to not just fixed income, but the global economy?
Yes, you're right. Look, we do seem to have a repeat of that election, but I think regardless of the specifics of how it shapes up and frankly who wins, I think the more interesting part about really all of the points that you mentioned are some of the broader changes that we're seeing in my opinion really kind of look to define not just 2024 but these the 2020s. We're looking at a period that where a couple of things have changed materially. So you clearly have a lot of countries, the US being one of them, that are looking a lot more inwards or towards their economic bloc. And that's what has shaped up some of the things that we see. For example, changes in trade relationships. The tariff headlines of Trump made a lot of noise, but I think really seen from a broader angle, they still fit within that theme, and that's something that you're seeing really across the board, regardless of who's going to end up being president. And that, along with another factor, which is the change in the drive towards climate. You're getting a lot of changes in technology and where that's going to go. These are just some of the factors that are moving us towards a world that is seemingly more inflationary, I would say, kind of from a very basic level. So, if I think about one of the things that has changed materially for us in the last 2 to 3 years is that, and this, really rhymes a little bit with one of the earlier points that we discussed about this re-rating of fixed income. A part of it is a re-rating in the broader economic conditions that have given us an extremely borderline deflationary world that we've lived in a while, to one that will be at the very least much less so. So when you consider, all of these factors, another really important one, which, again, we could probably have a whole podcast just to discuss it, but it's really important changes in demographics as well. China is an extreme example, but I think around the world, you're seeing important changes in working age populations, and we're starting to see that in tighter labor markets, lower unemployment numbers, and these aren't simple variables to make a forecast on for any short period. These will not make a good trade recommendation over a quarter or two, but I think they are important in a global prospect of how do we see a lot of the factors that define some of the monetary conditions that affect us all. Right. So for me, when I think about portfolios that I manage for the region, I'm not an expert, obviously, on US economics or US politics, but an important factor that does pervade everything that we do is that, monetary policy impacts financial conditions, and financial conditions eventually, impact the economy. And those dictate a lot of what we use to price risk, and to value opportunities that we look at. And then, so if we look at a world where rates are going to be higher in the way that they are now, that's something that we need to consider in how that that impacts everything that we look at.
Yeah, it just seems like, there was a lot of talk earlier in the year or late last year of a rate cut, but obviously I guess now, it's going to be a bit delayed. I mean, if there is a interest rate cut in the US, what kind of an impact does that have on the Middle East or like emerging markets, fixed income market? Does it have like a adverse effect, or is it like a good thing or a bad thing?
That answer very often depends on the reason the cut happened. So if the Fed cuts interest rates in a measured fashion, without a reaction to materially bad news, that would typically be conducive because if you think of kind of the variables that I mentioned earlier, think of monetary policy impacting financial conditions that feed into the economy. A monetary policy that eases financial conditions would be positive for economic growth. And given that, for us, for our region, for the GCC, we're directly tied to US monetary policy, there would be a positive feed through. Now, the reason the answer to that is a little bit complicated is because it's rarely the case that the Fed would move rates meaningfully, let's say, in either direction, up or down, unless we're reacting to new information. So, when we think of the next steps for the Fed. There's obviously a lot of noise about small measured steps that could happen. That's what the Fed would like us to believe. But history would suggest to you that that's actually quite rarely the case. There's probably a more realistic view of the world where you would consider that things likely stay the way they are with the highest probability, but that you have actually two tails that are probably more likely to happen than people expect, but that are on both sides. So one of them being that an unforeseen situation happens that requires more rate cuts than expected, or our assessment of the economy turns out to be wrong, and we're not going to see a cut next, but we might not get a cut at all, perhaps a hike. So it's those events that will shape a more material change in the way we are rather than the current situation.
And what about your thoughts on things like geopolitics? Do they have a big impact on the markets in the Middle East? Or because like it just seems to me there's a lot of geopolitics, but the fixed income markets are kind of like ignoring what's happening.
Yes, that so typically the impact of geopolitics of the region has always been quite short. You tend to have, what's relatively a knee-jerk reaction, so at the headline of certain news, which tends to be digested and to fade away over time. And that's part of that just being that geopolitics often has not had an extremely escalated or material outcome, right? Most situations do tend to be contained and go away. Now that would be ignoring some situations. So for example, Lebanon has obviously had a debt crisis. Now did not precipitate from a geopolitical event. But it does not mean that geopolitics does not impact some credits in a way that could deteriorate them quite largely. But for the majority of the world that we look at when we look at MENA, kind of to the point made earlier, GCC is a very important component of that. And you're looking at a set of countries that's actually very high quality and are fairly wealthy. So they're very unlikely to be overly impacted by short-term news.
Yeah. And just sticking with the Middle East fixed income for a second, what are your thoughts on oil prices for 2024? Do you see them at these levels, or do you see them going down or going up?
Um, frankly, oil is not something that, well, it's not easy to forecast for anybody. For fixed income investors, it's typically not actually a very important factor, and the reason for that. And I'm not running away from your answer. I'll give you one, but I was just give you some background to sort of the framework that we think about it. Is that the way it tends to impact us on the fixed income side is that it's more important at extremes. So, if you kind of think of it, oil, for example, has a very large impact when it's below 40, and then, potentially can have, other impacts on policy when it's above, 100 or 120. So then you have a large range in the middle where really it doesn't, it doesn't permanently impact, the credit profile of a country. So you wouldn't see spreads of Saudi Arabia, for example, reacting to whether oil prices are $70 or 75. And
Mm.
so, it seems like we will be within a range that I think is relatively conducive for fixed income, at a number that will roughly balance most sovereigns in the region. what I think the challenge that we have in having a stronger view is that we're really trying to balance two factors in the way we look at oil. On the one side, there's a belief that the industry is underinvesting, and that oil is going to be important for a long time, even in a net zero perspective. So that's a lot of the message that you get out of the GCC, and so COP in Dubai, with the presidency being the UAE, that was one of the messages that was coming out, so that you will still need the region. The region still needs to produce oil, well into the future. Versus on the other hand, you have this transition to clean energy, where on one hand you have some participants saying that we need to move to be fully clean energy. So those are two, frankly, quite extreme outcomes that we're going to have to face over time. And I wouldn't claim to really have any of the right expertise to make that. And it really kind of pulls in two very different directions. But for now, the most important thing, which is why I say I don't think there's a level that's materially impacting to us as credit investors, is to the point we made earlier about the way we see economic conditions is growth in most places, most of the large places, the US being an important one, GCC is another one. Growth is still positive. Financial conditions are still relatively easy, even though rates are higher, and I know that has been a surprise to most people, myself included. And you're still seeing kind of positive impacts of growth, and a slightly inflationary environment, which is also positive for commodities. So at the face of it, there's enough ingredients for now to support levels where we are.
Yeah. Sharif, moving on to private credit. What is private credit in a nutshell, in your opinion? What is private credit? Because I've been reading a lot about it, and it's very big in the US. But from your perspective, how would you describe private credit? And is there a private credit market in the Middle East?
Yes, look, it's a very good question, and you're right. It is something that's making a whole host of headlines. I would personally look at private credit as the world of a world of fixed income investing that is largely illiquid. That would be kind of the broad definition that I would give it. On in a more technical definition, it's the part of the credit market that is financed outside of the public bond world and outside of out of the banking space, and that creates a certain few pockets that really are underserved by those two other factors that I mentioned. So we mentioned a little bit earlier about we take the MENA as an example, that banks that SMEs in the region are really underrepresented in within bank loans. So that would be one sector, that would fall into the private credit world, and where private credit investors are best suited to provide capital to those industries in a way that other markets don't. So if you're going to take a live example, if you're a corporate, an SME with $10 million of revenue, you're too small to go to the public bond market, right? Most public bond deals would have to be several $100 million. They cost much more in fees than a small company probably can justify, and certainly those debt sizes will be too large to manage. And then on the other hand, for banks, they tend to not have the right kinds of collateral or the right kind of relationships to secure the right kind of bank lending. So it's really this space that's capturing a part of the the requirements for funding around the world that are not captured by what used to be the main sources of funding, right? So your public markets and your banks. And in a very interesting way to see how this has evolved is a big part of the growth that we see in private credit today is a lot of what's happened in the US. And that evolved out of the changes that happened to the banking system after 2008. As banks grew to be more regulated, the projects and companies that they would finance have changed quite materially, and there's a sort of a host of reasons that we can get to on whether that was positive or not. But really, the result of it was that it created an opening for another kind of financier to come in and to specialize in that space and to grow it. Now, in emerging markets, we're still at a much earlier stage, so you can tell, as my own definition at the beginning defined it fairly broadly. but in a more sophisticated market like the US, the private credit market has developed into, into several subsectors, each, dealing with different parts of the universe. So, one of them would be called direct lending. That would be where companies, directly go to get, so there's with loans to SMEs. Another would be infrastructure funding. Real estate falls into a certain part of that. So there's different subsects into it, all of which are kind of defined in that. But really what they all have in common is that these are, relatively higher yielding, often less liquid, and slightly more risky investments than you would typically find in your public markets.
And in the Middle East, do you think there is this private credit market, or do you think it's still at quite a nascent stage?
I think the market in terms of, the for these deals is still at a nascent stage. But I think the market on the supply side, so in terms of the availability and the requirement for capital, is actually enormous. So, if you call, so we mentioned earlier kind of two major things. And if you just consider those two alone, you can sort of get the sense of the scale that I would describe here. On the one hand, you have a current underrepresentation of small and medium-sized enterprises in the banking universe, so in the amount of loans outstanding. And then you have the amount of money that we discussed earlier about that is just required to fund these massive reform agendas that we're talking about. And if you really just consider those two factors, there are, there could be upwards of 300 or 400 billion dollars of investments that are required, on this private side. Today, there's really very few, if any at all, private credit players with any meaningful scale, let alone something to the magnitude of the figures that I'm discussing. So I think it's a little bit of a chicken and egg situation, right? Because you often you need the capital to find the deals, and the deals need the capital. But in my opinion, the requirement is undisputable, and the direction of travel towards the growth of this market is also undisputable. And one of the things that I personally find really attractive about this is, in our earlier discussion, I highlighted how important, in my opinion, finding uncorrelated returns, in this current universe. And private credit is one of the ideal candidates for that exact same function. One of the very popular ways to invest for a long time has been called what's the 60/40 portfolio. So that's, one that's made up of, 60% equities and 40% bonds. And that's a mix that has worked very well for people for a very long time. A part of the reason it has worked has been that negative correlation between bonds and equities that kind of created, a much more improved portfolio as a whole from a risk reward perspective. Now
Yeah,
that might change, you start needing to look at different ways to complement your portfolios. And some people will tell you that's Bitcoin. Some people will tell you that that's importing some commodities into your portfolio to hedge against inflation. But in my opinion, a very simple answer to that is private credit.
yeah. I think like it's interesting if you look at the kind of institutions or organizations. I guess like it's these large like private equity or NBFIs that are giving these kind of or structuring these kind of deals. Because I think there was a Mubadala did a deal I think with Goldman Sachs, I want to say, on a private credit fund.
Correct.
Um,
Correct.
but what one thing I wanted to ask you, the private credit with say Mubadala or ADQ or PIF or say Qatar Investment Authority, if they are doing something similar, is that this money or these investments are outside of the region, right? They're not taking place in say like Egypt or in Middle East.
No, no, that's exactly right. There's very few that have been directed towards the region. Most of that capital has flowed towards developed market first. Frankly, in part justifiably so. Those are the deepest, most developed, and particularly for these large institutions in the region that are required, to invest in large ticket sizes. They have gone to the more developed, and deeper markets first. Now, the importance of the deal that you actually just mentioned, which is it's very timely, is the fact that this was an emerging market one. So the Mubadala deal with Goldman Sachs was for private credit in India. So that this is relatively new, and you're starting to see sophisticated investors look at, the next stages of where this market could go. And I think that's only a matter of time that is going to see that trickle down happen emerging markets in general. Some of the big ones will be the initial beneficiaries. Obviously India is a very clear target. But second to that, I think you'll very quickly find the GCC to rank very highly in that regard. Again, really some of the same things that make it one of the more interesting parts of emerging markets from the public bond side will be the same on the private credit side. Issues of the lack of currency risk, the fairly high quality, and the new and improved reform frameworks that are in place, around all of the things which private credit hinges on: the security, the legal framework, the bankruptcy, the testing of the bankruptcies, all of these things that are ongoing as we speak are sort of placing, a very, all the correct ingredients in place, for this asset class to flourish.
Yeah, it seems like it's a bit of trial and error, or they're just like dipping their toes in the water to see how it goes before they fully like engage. Sharif, one area I really wanted to talk to you about was global sukuk. I know at your time at Franklin Templeton, you were also, in addition to the Middle East bonds, you were very involved in the global sukuk market. Um, from your perspective as a portfolio manager, what are your thoughts on the sukuk market, the global sukuk market since 2014, would you say?
It's well, I guess to be fair to the sukuk market, we'd need to take it back a little bit longer. And Frankly, your discussion with Harris was a really good one to describe some of the early days, of some of the mega deals that were pre-GFC. And those were some of the areas where we saw the likes of the DP World convertible and the Nakhil Sukuk back in the day, these kind of infamous instruments. And so we had a, kind of a very interesting, let's call it pre-2008 period where you really started to see some very significant developments happen in the Sukuk space. The 2009 debt standstill of Dubai, put a lot of things on the back burner in the region in terms of development, even though it created a lot of interesting opportunities for us as portfolio managers. But then a lot of that came back to life again, in the period between 2014 and 2016, and that period coincided with really the entry of issuance of the GCC, which was ultimately sort of forced by the material decline in oil prices. And we've seen a flurry of issuance in general from the region, even though that has favored the conventional markets a lot more. Sukuk has obviously benefited as well, and you've seen issuance grow. Now, the criticism I would have from as a portfolio manager is that I think where, even though you've seen growth in the market, and certainly in some places quite significantly, where we have not seen enough growth is on the corporate and the high yield side, which actually brings us to an interesting point about the conversation we were just having on private credit, that that asset class could bring two interesting things to Islamic investors. One being diversification in terms of the ability to allocate to new issuers in different sectors, with new interesting risks. And second, and perhaps just as importantly, and maybe more importantly for some, is the degree of Sharia compliance of the structuring of the product. So that, as I'm sure you're aware, has also had a few hiccups over the years that have disrupted the growth of the sukuk markets. One of the famous ones was, the IOFI change in rulings, about a year or two ago, that almost stopped sukuk issuance, altogether for a month or two. So it's it's a market that's in a state of evolution. Again, I think your discussion with Harris is probably quite interesting on it, but it's certainly one that's look, it's very close to my heart. As you mentioned, it's something that I've worked on for a long period of time, really for all of the time that I've been working on MENA capital markets. I've always had an involvement in sukuk, and I'm a strong believer that the asset class will grow to be a substantial one. Here again, you have a situation of there's an extremely large interest in seeing this product develop, and we're making strides along the way. And ultimately, the product is not going to be perfect at every stage. And many would criticize some parts of the market today for not being, truly compliant. But I think, a fair counter to that would be is that, there's a lot of ways to look at it as a means to an end, and that evolution is important. I personally think to complementing it with some of these, new products and innovations. And I think private credit will probably be a very good catalyst for that. We'll see us kind of make the next steps in it growing to sort of being its own really than just simply a replica of conventional markets.
Yeah, I'm just curious. When you look at like sukuk transactions, do you look at the Sharia compliant aspect of it, or the underlying assets per se, or do you really look more at like the credit metrics, the rating, and things like that? Because I think this is like a criticism of people have, right? Is that it's replication of conventional bonds. But from your perspective, having invested in sukuk in the GCC and in Malaysia and in other jurisdictions, would you say it's more like of a credit story, or do you think it's more like, investing in something that is actually Sharia compliant?
It's almost all, simply credit stories, frankly. I mean, that is a very fair criticism. That is the reality of what the majority of the publicly available sukuk market today. A lot of it is, as you mentioned, simply structuring work that's ultimately intended to, replicate, the credit risk of a conventional bond. Now, I would still say for most investors in this space, I don't want to, it would be unfair to say that we completely ignore the underlying structuring aspect because they have implications to the acceptability of certain instruments to certain clients. So that's a part of obviously our kind of the management process, and both clients and the market's understanding of which structures are compliant and to what degree is also something that evolves with time. Which even though I completely sympathize with any criticism of what it represents today, I would just kind of bring it back to the point earlier that I think most participants and investors in the space today do have an understanding of this limitation and see it as as an evolving process. In my opinion, that evolution needs to see it evolve, not just in terms of the technicalities of each contract and what it means and what it doesn't. So, to the IOFI change that I mentioned most recently was one, that changed the requirement around tangibility of an issue, for example. So those things do matter, of course, and they will and they'll continue. But really, I think, the time we're going to get a much more interesting outcome of this space is when we see a more true evolution. A lot of the structures allow, more true risk sharing, and a lot more alignment of interest between lenders and creditors. And in a lot of ways, that mix of assets is quite attractive. I mean, if you think of the point, really a lot of our discussion today and how we landed off, consider asset classes that you're looking at, uncorrelated risks that you're interested in, and something to evolve from the traditional 60/40 portfolio. A very natural one would be investments in the sukuk space that are higher yielding and that combine characteristics of fixed income and equity, which is really the true definition of what a sukuk is. So in some capacity, if you think the ultimate shape of what these instruments and portfolios look like, is a very good product that if it was available today, I think would actually garner a very large amount of interest. It would solve a lot of really all of the concerns that I've been mentioning today. So I think there really is a place for it. Evolution and big steps in evolution don't always happen very linearly. So it could take one time and one product that could change a lot. But I think it's important, and once it does become available in the right shape, it would be one that would change the shape of our market really.
Yeah, and kind of think of it like you as a fixed income individual, you're looking at it from fixed income and you have a certain risk appetite. And like if I present like a sukuk to you as a like kind of project risk, you're going to say, okay, Hassan, I want like 12%, not like 5%, which say a triple B rated or a triple whatever rating comparable would give you. Whereas if I'm asking you to take on like a proper project risk where, there could be complete loss of your capital, it's a completely like different asset class. Like I think as you alluded to, it's not really for fixed income investors, but I guess the market's at kind of this inflection point of like with the AOFI standard of tangibility, that's kind of like I think shocked quite a few people who were doing business as usual. But like when you actually break it down, I'd like I mentioned with Harris, uh, sukuk are supposed to be, profit loss sharing, risk sharing, more equity like. But again, like you're not a venture capitalist or a private equity person, so you would say I need like the rating and everything, right?
Well, that's certainly true, and that has been a lot of really the guiding principle that has kept us in the box that we have. But now, if you think of really where you're seeing most of the growth in fixed income everywhere, I mean, we've mentioned this earlier, but it really has been in private credit. So really so even though we've always been constrained by really honestly the exact scenario that you mentioned of once it looks like that, you can't sell it to a quote unquote fixed income investor. Now what you're seeing is that actually a lot of the marginal dollars, even from very sophisticated institutions, are embracing that risk. They're looking for private credit. They're looking for less liquidity, and they're looking for more risk in the right shape. And I think that becomes the important distinction here of, it doesn't have to be that simple triple B instrument. It has to be just commensurate for what it is. And once it is, and it's done in the correct format, I think you would see a lot of interest. There's, I don't see a reason that you don't kind of have that level of, the resurgence the way you're seeing now in the interest of, if we call them, the space of alternatives in general, Sukuk can very comfortably be defined as, a part of the alternative space. It should be, or at the very least should have, a product representative of that, in our space.
Yeah, and just on the sukuk market, is there a difference when you as a portfolio manager, is there a difference between like buying or investing in Malaysian sukuk or Indonesian sukuk compared to say the GCC from a credit perspective or from like a risk perspective?
Well, from a risk perspective, each represent their own underlying risk. So there certainly are some differences within the public space. Again, frankly, not very much. Certainly from the sovereigns, they tend to follow fairly similar structures. So not quite. Um, I think from the corporate side, you start to get a little bit more because each are governed by different jurisdictions. But really, unfortunately, the answer to that is nothing to that's specific to sukuk. Most of the really kind of the point earlier, a lot of the public sukuk market really represents issues that are just replicas of what they would have been in the conventional side and are just a function of the underlying credit risk.
Yeah, and
So in terms of the difference in regions, the only some differences is, you start getting a lot more complexity on the structures in some of the local issuance. So you have a really large market in Asia, in particular in Malaysia and Indonesia, that issues in local currency, and those tend to be structured in ways that often are not accepted by scholars in the GCC. So that's where you do see some distinctions, but most of I think the points that you mentioned earlier, everything I was discussing was talking about the liquid hard currency dollar space.
yeah, I guess another thing sticking on the liquidity is that sukuk generally are, a lot of people, a lot of critics would also say that sukuk is a very illiquid market compared to say like the conventional bonds. Would you say that's because like most sukuk buyers or investors are Islamic banks, so they don't really, they just hold buy to hold. They don't really like trade this stuff in the secondary market.
That's part of the consideration, certainly. And you have it's often kind of labeled as the demand supply imbalance that you just tend to have a little bit more interest in sukuk because there's more liquidity looking for them than otherwise. So that often can be a factor. However, one point to consider is that often so a big part of the sukuk universe is issued in a format that is tailored towards some of the less volatile type investors. So you made a good point about a lot of it that goes into for example bank treasury books where it tends not to be traded. But that's also a function of the fact that a lot of the issuance is done in, tenures and qualities, and from issuers that fit those bill quite well. Um, where, in a lot of other non-sukuk issues, those issues, might be a little bit less liquid. So, here there's a problem of what the universe is as well. It tends to be a slightly lower duration, higher quality, um, uh, type space, which falls victim to that. But I think the statement is relatively correct that, on average you would expect the sukuk to be slightly less liquid than a conventional bond.
Great. Sharif, as we bring the podcast to a close shortly, you mentioned that you're now working with Amwal Capital Partners. Could you tell us a little bit about who they are and what you're doing there?
Yes, of course. Amwal is a MENA specialized firm that has been running a very successful equity strategy for over 10 years. I joined them along with my partners in a Riz from previously from Arqam Capital to start a fixed income department and launch strategies focused on the region, really to capture just a lot of the points that we mentioned earlier. We think we're looking at a very interesting space, at a very important time for fixed income with some really decade-long changes that we're undergoing now that make the space more interesting than it's been for a very long time, and changes that are happening in the region that are also material in a way that that really we haven't seen in our lifetimes. So we're looking to take the best advantage of that we can, and hopefully give our clients products and investment opportunities that take advantage of that and that are unique and value added.
Great. And when do you plan to launch the fund? Is it coming soon or is it coming later on in the
Uh,
year?
Yes, it's in the works. So we hope to be launching something in the Islamic space,
Nice.
and hopefully to address some of the points we mentioned earlier about a product that provides a more distinct and unique solution, combining opportunities in public and private markets, that would be differentiated and offer kind of more interesting returns and opportunities to our clients. So I hope to be somewhat of a driving force in the change and the evolution that we talked about earlier.
No, definitely you're a driving force. And Sharif, finally, how can people get hold of you? Are you active on social media or do you write about your thoughts or how can people read what you're talking about?
LinkedIn would always be the best way to reach and find me. I have in the past tried to pen my thoughts, and I do very much like to write. I haven't done it too frequently recently, but it's something that I hope and intend to do a lot more in the coming months.
Inshallah. Sharif Eid, it's been a pleasure. Thanks for coming on.
Pleasure's mine.